Hey everyone, welcome back to another Explainer. Today we're unpacking some truly fascinating material from Apex Executions, looking specifically at their institutional algorithmic trading validation process. If you've ever wondered how the pros separate genuine algorithmic trading skill from pure dumb luck, like a monkey throwing darts at a stock ticker, well, you are absolutely in the right place. We're going to walk through what can really only be described as a brutal, multi-stage survival obstacle course for trading algorithms. Our focus today? Apex is absolute statistical edge against randomness. So let's just get right into it. The Sharpe ratio, NICE. We correct it. I mean, talk about a provocative hook, right? If you're familiar with finance, you already know the Sharpe ratio is basically the golden calf of risk-adjusted returns. But the source material from Apex drops this truth bomb right out of the gate. Standard backtests often just show lucky curve fitting. Every single time a researcher tweaks a parameter to make a past chart look just a little bit better, that standard Sharpe ratio artificially inflates. Basically, it lies to you. Okay, let's dive into this a bit deeper. On one side, we have the illusion, a curve-fitted simulation. This is exactly what happens when you optimize an algorithm so perfectly to pass data that it looks like this flawless, guaranteed staircase to wealth. But on the other side is the reality that Apex actually demands, the out-of-sample equity curve. This shows how the algorithm performs on data it has literally never seen before. We're contrasting the mirage of a lucky backtest against the hard, undeniable reality of true, out-of-sample skill. Which brings us to stage 1, removing the bias. So to fix that lying Sharpe ratio we were just talking about, they use the deflated Sharpe ratio, or DSR. This mathematically adjusts for the number of research trials you ran, and it also accounts for wild swings and extreme outliers, the skewness and kurtosis. Basically, it penalizes the algorithm for every single time its creator tried to optimize it. It deflates that inflated standard metric to give us a conservative, statistically honest measure of performance. But the DSR doesn't work alone. It's paired up with a PBO, the probability of backtest overfit. Think of this metric as a very strict gatekeeper against randomness. It mathematically bounds the danger of optimization by calculating the exact probability that an algorithm's winning result is just a lucky artifact. Essentially, it asks, did the creator just search through thousands of parameters until they found the one that happened to work in the past? The mathematical cutoffs required to survive this very first stage are unforgiving. To even advance, an algorithm must maintain a deflated Sharpe ratio of 0.60 or higher, and its probability of backtest overfit must be strictly under 30%. If it fails either of those, it's out, done, no exceptions whatsoever. Now, assuming an algorithm actually survives that, it enters stage 2, the blindfold test. Here's how algorithms are forced to trade completely blind into the future. First, you optimize the strategy parameters on a block of historical in-sample data. Second, and this is absolutely crucial, you freeze those parameters solid. Third, you test it on the immediately following, completely unseen out-of-sample period. The absolute rule here is no peeking allowed, zero look back. This process repeats sequentially across the entire price history because for Apex, out-of-sample data is the only truth in trading. To clear this blindfold test, the strategy has to hit 60%. Meaning an algorithm must achieve a 60% out-of-sample consistency requirement across all of those sequential windows. It has to prove it can consistently adapt to unseen data, over and over and over again, just to survive this stage.
All right, things are about to speed up now. Enter stage 3, the multiverse of randomness.
Over 1,000. That is the massive number of resampled paths evaluated per strategy in this layer. Apex uses a highly advanced technique called block bootstrap resampling. Think of it kind of like shuffling a deck of cards, but keeping certain specific sequences of cards perfectly intact. This method preserves the natural clustering and structure of historical financial returns, but it generates over 1,000 alternative price paths from that exact same underlying data. The strategy has to prove it's genuinely skilled across all these resampled scenarios, not just the one specific timeline it happened to be developed on. Next up, the strategy faces combinatorially purged cross-validation, or CPCV. This divides the historical record into multiple folds, placing strict embargo periods between them to prevent any information leakage, basically ensuring the algorithm can't accidentally peek at the test answers. By testing every possible combination of training and test sets, CPCV ensures that the strategy's success isn't just tied to one lucky historical sequence. It produces a massive, rigorous distribution of performance paths. And, if that wasn't enough, 10,000. 10,000 Monte Carlo paths are simulated per strategy. That is a staggering amount of alternate realities. They reorder the actual trade sequences 10,000 times to build 90% confidence intervals around everything: the Sharpe ratio, max drawdowns, profit factor. This aggressively flags any path-dependent illusions. If a strategy looked amazing in history but suddenly has massively wide confidence intervals here, it gets thrown right out. Moving right along to layer 6 in the stack, we hit stage 4, real-world physics. Now, a strategy might survive the math, sure, but now it has to prove it can actually handle the brutal, shifting realities of live markets. And this brilliantly illustrates exactly how they test it. Apex slices the strategy's performance by market regime: bull, bear, and lateral, or choppy, markets. The requirement? Positive expectancy in all three. If an algorithm only makes money when the market is going straight up, it gets flagged and demoted for just being a bull market passenger. It has to win everywhere. To prove this, Apex doesn't just, randomly shuffle data around. They simulate another 1,000 regime-conditioned equity paths. But they do it using a Markov chain model. Why? Because a plain shuffle destroys the way real drawdowns cluster together. The Markov chain actually respects how regimes transition in the real world, so they're simulating realistic, clustering storms, not just long-run averages. Let's see how this all builds into real execution. Surviving all of that math dictates how the algorithm is actually sized. Apex mathematically calculates optimal position sizing via the Kelly criterion based on win rates and average losses. But they don't just blindly follow it. They temper it by implementing a fractional, half Kelly, to reduce overall volatility. Furthermore, they utilize incredibly strict per-ticker drawdown override circuit breakers. If a sudden regime change occurs and equity drops, these circuit breakers automatically halt the strategy in its tracks. We have finally reached the ultimate hurdle, the final boss, Gate 7, the benchmark gate. So, here's the most crucial, devastatingly simple question of them all: algorithmic strategy excess return versus plain buy and hold beta. In other words, after all this complex math, does the strategy actually beat simply doing nothing and holding the exact same ticker? Is it real alpha or just a leveraged bet on the market going up? To pass Gate 7, the strategy must prove its edge is statistically real, not just noise dressed up as skill. Alpha generation has to be greater than 0%, meaning a positive excess return after subtracting market exposure. And it must pass a one-sided block bootstrap significance test with a p-value of less than 0.05 on that excess return. Without clearing these incredibly strict metrics, the strategy is rejected, regardless of how gorgeous its raw Sharpe ratio looked back in Layer 1. So, what is the ultimate takeaway from this source material? Simply put, only the best survive. There are no handpicked results here. There is zero survivorship bias. Every single ranking on the Apex Executions leaderboard is a reflection of out-of-sample performance that has been completely brutalized and validated across 6 rigorous statistical layers and multiple market regimes. If a strategy is green on their leaderboard, zero luck was involved. It earned it. Which leaves us with a final, vital question for your own analysis. Is your trading strategy mathematically robust, or is it just a lucky passenger in a bull market? The tools to find out are out there. Thank you so much for joining me for this explainer today. Keep asking the hard questions, always demand statistical proof, and I'll see you in the next one.